Good morning, everyone. I want to believe that everyone can hear me. I welcome you all to today's training section, day 3. Our training topic for today will be on financial planning and bookkeeping. So I have been introduced on the platform, the WhatsApp platform. So my name is Oheru Chichuku. So here are the course objectives for today's class. It is expected that at the end of this training session, you, the participants, should be able to, 1, understand financial planning activities, what we refer to financial planning activities and what it entails. You should be able to differentiate long-term from short-term financial plans. 3, understand the reasons for bookkeeping, the main reasons why companies have to maintain their bookkeeping, their financial records. 4, identify bookkeeping methods, various bookkeeping methods available to us, even as accountants and non-accountants. 5, record financial transactions. Show you how to record your financial transactions. If possible, we see how we can balance our books. At the same time, I understand that not every one of us have accounting background, so we'll see how this can be taken care of. So it's expected that at the end of this training session, you, even as non-accountants, you should be able to maintain your financial records as well, plan your financial activities, because these are very key activities for every business that seeks to make progress and succeed. So let me start off by telling you this. Let me use this scenario. You can't run a healthy, successful business without having your books in place. It's not possible for you to have a successful business outfit if you don't have your financial records in place. Any attempt to do that, to run your business without having financial records in place, you will be likened to a man who drives a car without a fuel gauge or a map. And you know what happens when somebody drives a car that has no fuel gauge map? Sooner or later, the person will run out of fuel or out of gas. And if you run out of gas or fuel, your car will be forced to be towed away or to be pushed aside. So the same thing, I want to liken this to not having financial records in place for your business, as well as not maintaining adequate bookkeeping for your business or your proposed business. So all of this we shall be discussing this morning, this training session. Let's start off by looking at financial planning. Financial planning is a plan needed for estimating the fund, determining the sources for same. What we simply mean is that the act of financial planning is that act that requires every business entity, every company, every entrepreneur to establish how much is needed for the intended business. First, you must identify how much in terms of naira and kobo that is needed for that business of yours to thrive. So having known the amount that is needed for the business to be set up, you need to also identify the sources of the fund. I mean, where will the money be gotten from? Should the money be gotten from any of the finance institutions like commercial banks, money market banks, discount houses, even microfinance banks, the likes of NISAL microfinance banks, or that? So the source, I mean, where the funds will be gotten from, is an activity that is carried out under the financial planning activity. Also, having known where the source will be, where the money will be gotten from, you need to also ascertain when the money will be needed. I mean, this answers the question of timing. So to be sure that the funds are readily available when they are needed, because no average investor will want to take up funds that are not immediately needed for injection into the business. Let me also state here that for every fund that is taken up for your business activity, there is what we call cost of capital. Some people refer to it as borrowing cost. There are borrowing costs associated with it. So a rational businessman or woman will always want to keep these borrowing costs very minimal. So we must plan the timing when these funds are going to be taken. So it's financial planning is essentially includes generating a financial blueprint for your company's future activities. So when we try to chart a blueprint, financial blueprint, the way and manner that the company should be run in the future, that is referred to as financial planning activities. So these are the objectives of financial planning, the reasons why companies engage or indulge in financial planning activities. Number one is ensuring availability of funds. Once you plan your financial activities, you are basically ensuring that funds are available for the intended business. So, because funding or finance is very key for every business growth or establishment. For every business growth or establishment. Two is estimating the time and source of funds. You need to estimate the timing and the source of funds. We have talked about timing, when the money or the finance will be needed for injection. Like I told us earlier, the timing is very important. We guard against the company taking out funds and not investing it immediately into the business or into the proposed business, because like I said earlier, for every fund that is taken up by a business entity, that fund has what we call cost of capital, borrowing cost, or finance cost, as the case may be. So in order to keep this borrowing cost, this BRS minimum, you need to estimate the timing of the fund, as well as the source of the fund, ascertaining where the funds will be gotten from. I know most of us have already estimated the source of our funds. Most of us are believing that, yes, the source of our funding for the proposed business activity will be from NISA Microfinance Bank. Yes, that is part of the financial planning activities. And thirdly, generating capital structure for the business. Capital structure is so important for every business establishment because you need to split your total capital requirement between what we call debt and equity. Equity is the fund contribution or fund injection by the shareholders, and people will call equity participants, the owners of the business. Any amount that is brought into the business or introduced into the business is what we call equity. So owners of the company bringing in their money, injecting in their money into the business, that money is referred to as equity, while debt is the other portion of the capital that has been borrowed, which cannot be raised by the shareholders. So you see, for every capital structure, it is split between debt and equity. One that is contributed by the owners of the business, that's equity, and the one that is borrowed from third parties in order to fund the business, that is debt. So it is very important in generating a good capital structure for every business, because any attempt, if this is mismanaged, if a company allows its debt to be more or to outweigh the equity, it puts the company at risk of insolvency, risk of failure to meet up with principal and interest repayment, risk of liquidations and all that. So in order to guard against all of this risk, inherent risk of business, you need to generate a good capital structure that is sustainable and principally ensuring that your equity contribution is always greater than the debt what you are borrowing. Then the last objective of our financial planning activity is avoiding unnecessary funds. It's very important to know that, like I said earlier, every fund that is taken up for injection into the business has attendant cost of capital. It has what we call borrowing cost. Even the money you are to take up that you are proposing or intending to take up from NISA Microfinance Bank, there is borrowing cost, there is cost of borrowing, finance cost attached to it. The funds are not totally free, meaning that you have to pay interest on them. And for you to minimize the interest payments or to bring it to its barest minimum, you need to do what we call timing of the fund injection to be sure that the funds are taken up when they are immediately required. So you don't start bearing unnecessary interest charges when the business have not commenced operation in its commercial quantity. So these are some of the objectives of financial planning while companies indulge in financial planning activities. Now let's consider the two types of financial plans available to every business entity. We have the long-term financial plans and the short-term financial plans. Long-term financial plans is also referred to as strategic financial plans. Long-term financial plans is also referred to as strategic financial plans. And long-term financial plans consider a number of financial activities. Consider a number of financial activities which includes proposed fixed asset investments, research and development activities, marketing and product development, capital structure, and sources of financing. Example, proposed fixed asset investments, which borders on long-term financial plan. A company may be proposing or thinking of how to finance its fixed asset acquisition or investment. Imagine if you are into farming and you are considering how to invest in one of your fixed assets, maybe for instance, tractor, and you are asking, how should this be done? How should you finance the tractor? The company has various options available for it to finance this tractor. Either the tractor should be bought outrightly if the company has the cash, the liquidity is there. The company can buy this tractor outrightly, or the company can go into what we call finance lease, where the payment will have to be done on a series of installments. So these are options available that are considered under financial planning activity under the proposed fixed asset investment. Another one could be research and development activities. The company indulges in research and development activities aimed at developing or discovering a product or a prototype. So these borders on long-term strategic financial plans. Marketing and product development also borders on these long-term financial plans. Then capital structure, like I told us earlier, taking decisions that border on how the capital structure should be split between equity and debt. Then lastly, sources of financing. You need to decide the sources of financing is also very key. Any activity that borders on sources of financing, where the funds should be gotten from, this also borders on long-term strategic financial plans. So these are some of the activities that are included under the long-term financial plans. These plans are generally supported by a series of annual budgets and profit plans. Even though we say long-term financial plans take a considerable number of period of time for it to be implemented or for it to plan, it is also supported by annual series of budgets. So how do we know that a plan is of a long-term financial plan? Most times we look at the number of years or the period that the plan covers. If a financial plan addresses issue for a period of 3 years and above, do know that such plan is a long-term financial plan. So long-term financial plans addresses financial issues that borders on 3 years and above. So a good way of knowing that a plan is of a long-term financial plan is when you look at the period that the plan is meant to address. If the period is up to 3 years and above, you do know that such plan borders on long-term strategic financial plans. So after the long-term financial plans, the next type of plan is the short-term operating financial plan. This takes the opposite of the long-term financial plans. For the short-term operating financial plans, they specify short-term financial actions and the anticipated impact of those actions. Typically, they cover a period of 1 to 2 operating periods. So this takes the opposite, like I told us, of the long-term financial plans. And these short-term operating financial plans cover just a very short period of time. Any plan that addresses issues bordering on 1 to 2 years, you know that such plan is a short-term financial plans. I give you an example of short-term operating financial plans. The plan that is set up in order to manage a company's working capital. Working capital comprises current assets and current liabilities. Current assets, for instance, examples of current assets are inventories, receivables, and the likes. If a company is trying to design a financial plan that helps it manage its receivable, for instance, receivable being one of the working capital tools, the company may take decisions, short-term decisions of financial plans that borders on how receivables are to be collected by the company. Receivables are those customers who buy on credit, and as such, they now owe the company. The company may decide to allow a 1-month credit period or a 2-month credit period or even a 3-month credit period. And the higher the credit period, the company may decide to say, okay, because we allow customers to owe us for this long, for 3 months, for 4 months, as such, there should be interest payment on the outstanding amount. So all of these activities that borders on the short-term financial plans is considered to be on the working capital. Okay, so we have cash budget. There's what we call cash budget. Cash budget is a very useful tool. Cash budget is a very useful tool for planning our finances. We use cash budget for our financial plans. And what then is a cash budget? Cash budget is a statement of the firm's planned inflows and outflows of cash. Cash budget is a statement of a firm's planned inflows and outflow. When a company plans its inflows, a statement that shows when a company plans all its inflows, a statement that shows the aggregated income, cash inflows of the company for a particular period and all the aggregated cash outflows of the company for the same period. That statement is referred to as a cash budget. What cash budget does is to reveal to a company its cash position at the end of a financial period. And cash flows can either be in surplus or a deficit or shortfall. Then surplus cash budget simply means that the total inflows or cash generation, cash collection by a company is more than its total outflow of cash. So every rational investor, every rational businessman or woman will always strive to have a surplus cash budget, meaning that the inflows are more than the outflows. So that's what cash budget seeks to address. So don't forget that cash budget is a very useful tool for planning a company's finances. Cash budgets are typically designed to cover a period of 1 month, 1 year, and all that. So even though you may have a yearly cash budget, but these cash budgets are further translated into monthly cash budget, and from the monthly cash budget, they are then aggregated to give what we call the annual cash budget. Budgeting cycle. If you are considering going into planning and budgeting activities, here is a typical budgeting cycle. Number one on the budgeting cycle is the performance planning, meaning we have to follow this step. Number one, you have to you need to ascertain your performance planning. And when we talk about performance planning, we are referring to the company's objectives or goals for a particular business. Company's goal or business for a particular business and for a particular period. every company has a goal or objective for being into business. Every entity has goal or objective for being in operation. So depending on what the goal is, that is the first on the budgeting cycle. You need to ascertain what the goal or objective of the company is. And having ascertained the goal or the objective of the company, you go ahead to provide a frame of reference. A frame of reference basically is the benchmark. You set benchmarks for the goals you intend to achieve. Let me give you an instance. If you are considering going into farming and you want to cultivate, take for instance, 1 hectare of land, and your goal probably is at the end of the farming season, you should have a particular number of bags or ton of output. So it's expected that you must at least have done your research to have a frame of reference by asking questions from those who have cultivated that crops, what their average yields were in the time past when they farmed. So that will give you a yardstick for measuring your frame of reference for benchmarking your goal, for benchmarking your objective. Then, having done that, you go into the implementation proper, budget implementation. Like implementation of this planting now, this farming will be, you go into the planting proper. And once the planting is done, after implementation, you investigate variations. Variations can either be in 2 forms. You may have a favorable variance or unfavorable variance. So depending on whatever it is, you launch investigation, especially when the variation is unfavorable, is adverse. You launch investigation into the variation to find out the possible causes why you were not able to attain the specific number of output of the product you planted. Imagine you wanted to have at least 2 tons of maize, or 100, you wanted to have 200 bags of maize, and perhaps you ended up harvesting only 150 bags. So you may want to launch investigation into the possible causes of the variation, why the 200 bags were never possible, and you only ended up with 150 bags. So you investigate those variations and you take corrective action. That's the next step under the budgeting cycle. You take corrective actions. Corrective actions will be forestalling the reoccurrence of those negative incidences that hampered on the attainment of the goal, which was the 200 bags you early anticipated to harvest. So these corrective actions could be, you may want to say, oh, in next planning season, I want to plant on time, knowing fully well that you didn't plant early enough in the just concluded planting season. You want to use the right farm input or implement. You want to use the right fertilizers and all that. You want to use the right seedlings or maize. If you planted maize, you want to use the right seedlings for the maize and all that. So these are some of the corrective actions that you may take in order to forestall the occurrence of the unfavorable variance that you recorded. And after that, you plan again. Budgeting is a continuous process. So when we plan, after the implementation, we assess what the outcome is compared to what the budget is, and we take corrective actions. And having taken corrective actions, we plan again. So it is a continuous process that must be undertaken often. So here are the strategy. We have 2 types of strategy. We have the long run strategy and the short run strategy. So for each of these strategy type, we have the tools for addressing them. For long run strategy or long run plan, it's expected that we use long run budgets in addressing our long run plans. You have a long run plan, a plan that will span for a longer period of time, up to 3 years and above. It's expected that you also draw up a long run budget to help you pursue those plans rigorously. And if you have a short run plan, a short run strategy, is expected that you also address the short run plan using short run budget, a budget that covers averagely 1 year, 1 month, and the rest. So depending on the type of strategy that you have for your business, it's expected that you use the right tool in addressing or attaining them. It's what we call cycle of money. The primary function of finance is the movement of money from lenders to borrowers and back again. The money that is injected into every business tends to rotate. We call it cycle of money. It rotates in and out of the business. Let me give you an instance in a clear term. If you successfully secure the loan from the NISA Microfinance Bank and the fund is credited to your bank account, the fund is injected into your business. That fund that is injected into your business, credited into your account, money comes in, and the money will find its way out of the business. By the time you start making payment for salaries and wages, you start paying suppliers and vendors who provide you with one form of goods or services. So you discover that the money that was paid in by NISA Microfinance Bank finds its way out of the business to buy goods or services. And when the money goes out to buy goods or services, you make productions, you produce or you manufacture goods or services. And these goods or services you manufacture will make customers come back again to pay money to buy those goods or services. So you discover that the same finance that was injected into your business by NISA Microfinance Bank tends to rotate in and out of the business. And this is what we call the cycle of money. So the primary function of finance is the movement of money where the lenders and borrowers tend to exchange this finance in and out of the business. So this continues as far as the business is in operation. So let's consider what we call bookkeeping. Bookkeeping. Bookkeeping involves the recording on a daily basis of a company's financial transactions. Bookkeeping involves the recording on a daily basis of a company's financial transactions. The whole act of recording a company's financial transactions, every naira and kobo that passes through the business, having them documented or being recorded on a daily basis as they occur, as the financial transactions occur. This is what we refer to as bookkeeping. With a proper bookkeeping, companies are able to track all information on its books to make key operating, investing, and financing decisions. So it's expected that every company that has its books in place, proper bookkeeping, should be able to take key informed decisions that borders on its operations, investing, and financing decisions. So bookkeeping, the importance of bookkeeping cannot be overemphasized. So bookkeepers are individuals who manage all financial data for companies. Individuals who manage financial data for companies, just like the accountants, the account clerks, the bookkeepers, and all that. These are individuals who can help a company in managing their books. But let me state here that even as some of us, or most of us, may not have accounting background, it's also expected that by the end of this training session, you should be able to at least understand how to maintain your financial records, even as non-accountant. So whether you can afford the services of accountant or not, there are ways you can maintain independently your financial transactions. So without bookkeepers, companies would not be aware of their current financial position, as well as the transactions that occur within the company. Yes, why you need the services of accountants or bookkeepers in most cases is that they can bring some of the professional experience into bear. But in any case, if your business is so tender and you cannot afford the services of a bookkeeper immediately, there are ways you can maintain your financial records. That will be discussed in few slides away from now. So here are the importance of bookkeeping. These are the reasons why companies indulge or engage in bookkeeping activities. 1, reliable measure of a company's performance. Reliable measure of a company's performance. When companies maintain their financial record, it helps them to assess how well the company has performed over a period. A company is able to assess whether they are making profits or not, as one of the importance of bookkeeping. Secondly, it provides information for strategic decision. Companies that maintain their books, companies that have their financial records in place are able to take key strategic decisions, Let me give you an instance of some of these key strategic decisions. Imagine a company that has two operating segments. The company is involved into farming. One of the segments is a company farms maize or one segment, and a company farms yam on the other segment. So these are two operating segments. At the end of the financial or planting season, farming season, the company may be able to take key strategic decisions if it has kept its books in place, if financial records have been maintained. Such strategic decision will be assessing between the maize and the yam, which one brought or yielded enough profit and return to the business. And as such, the company may decide to pursue rigorously the one that yielded more return, more profit to the business than the other one that performed low or poor. So by closing, some of the strategic decision will be the company may decide to close the other one that didn't bring enough returns to the company and channeling all resources and all energy into the one that performed very well during the farming season. So that's what we mean by providing information for strategic decisions. Thirdly, provide benchmark for revenue and income goals. When we maintain our financial records, as business owners, we're able to match, to benchmark income and revenue goals. You clearly see areas that the company can earn revenue and income goals because you have maintained records in the past and you know your likely income earning activities and you're able to pursue them aggressively. Then fourthly, fulfillment of legal and tax obligations. Companies that maintain their financial records, their books of accounts, they are able to comply with the tax and legal obligations without hassles. I give you an instance. Some companies, I've seen cases where companies pay taxes even when they are not liable to tax, Companies that make losses are exempted from tax payments. If companies make losses, they're exempted from tax payments. You see these companies try in one way or the other in order to declare taxes so that they can have something payable to tax authority without being harassed. Reason being that they do not maintain accounting records, at least to justify or exonerate themselves that they have actually sustained losses for the year and as such be exempted from taxes. So that's why bookkeeping is very important. Then the fifth importance of bookkeeping is that it provides stewardship to investors. In modern day businesses, you discover that investors are quite different from the managers. Those who bring their money for the business to be run are quite different from those who oversee the day-to-day administration of the business as the managers. So for the managers to provide stewardship function, accountability function to the investors, the shareholders who have brought in their money, they have to maintain their books of account. There has to be adequate bookkeeping activities. And lastly, proper management of cash flows. When companies maintain their books of accounts, they properly manage their cash flow system. They're able to track and see how liquid they tend to be over a period of time. So these are some of the importance of bookkeeping activities. So there is what we call accounting basis. Accounting basis simply signifies the time period when a financial transactions will be recorded by the company. The time period that a financial transactions must be recorded by a company. That's what we refer to as accounting basis. So basically, there are two accounting bases. Available to every company. So every company has two accounting bases from which it can choose or adopt any one that they feel suitable for their business. Number one is a cash basis. Cash basis is an accounting basis that records financial transactions only when cash is actually received or paid. So under the cash basis of accounting, financial or accounting transactions are recorded only when cash is actually received or paid. Meaning, emphasis is on cash movement here. Once you use cash basis to maintain your financial record, it's expected that When cash comes into your business, you record the transaction. When cash leaves your business, you also record the transaction. So basically, you watch to see the movement of Naira and Kobo in and out of your business before you record that financial transaction, simply because you are operating on the cash basis. And emphasis here is on the cash movement. If cash does not move, you don't record that accounting transaction. Let me give you an instance. If you are into business, you're into buying and selling, you hold some of your goods to your customer, a very trusted customer. And this customer is promising to make payment in 1 month's time. Customers promise to make payment in 1 month's time. Now, okay, so welcome back. We apologize for the loss of connection. Okay, so welcome back. This was where we stopped before the loss in network connection. So we were on the accrual basis, and we said under the accrual basis of accounting transactions are recorded when they occur, even if cash is not received or paid. So here, we don't look at the cash movement. We don't look at the cash inflow or outflow into and out of the business. So emphasis is basically on the occurrence of the transactions. So let me also give you an instance. If, like the other instance I gave you, you said you sell your goods to a customer. The customer buys your goods on credit. The customer will make payment in 1 month's time. Even though the money has not been received, you have to go ahead and record your transaction, because we are looking at the occurrence of the transaction. Has the transaction occurred or not? You agree with me that the transaction has occurred, because for you to hand over your goods to a customer, it definitely means that the transaction has occurred, and as such, the transaction has to be recorded in your books. So I also give you another instance. You buy goods on credit from your customer or your supplier, and the payment will be made in the next 2 months. The question is, will you record the accounting transactions now that the purchase is being done, or you rather wait until you make payment in 2 months' time? So if it's the accrual basis, for the fact that the transaction has taken place, means you have to record the financial transaction. But if you are using the cash basis, for the fact that payment has not been made, payment will be made in 2 months' time, you rather wait until 2 months' time when payment is made, when cash is handed over to the customer, when cash is handed over to the supplier, before you can record the accounting transaction. So this is basically the difference between the cash basis and the accrual basis. Here's an example before us. Purchase 100 units of a product and we pay for it next month. So if you buy 100 units of a product and you will pay for it next month. Now, if you adopt the cash basis, meaning you use the cash basis for maintaining your accounting transactions, it means that no transaction will be recorded now that the purchase is being made, because money has not exchanged hands. No transaction under the cash basis. Because for you to record your transaction under the cash basis, you look at either the inflow or outflow of cash. So, but for the accrual basis, even though money has not exchanged hands and you are bought on credit, the fact remains that transaction has taken place. Because for anybody to supply you 100 units of this product, it means that the exchange transaction has taken place. As such, the transaction has to be recorded in your books. You have to record the transaction in your books. So the point I want to make here very quickly is that you cannot use the two bases of accounting simultaneously. You have to use one out of the two. So the company has the right to elect which one it wishes to adopt, and anyone that is adopted is expected that you apply it consistently. Consistent application is very important. You cannot use the cash basis this year, 2020, and next year you want to switch to accrual basis. That is totally forbidden in accounting. Any attempt to do that will make your financial statements between the years incomparable. I mean, if you use cash basis of accounting in the year 2020 and the year 2021, you decide to switch to the accrual basis, it means that your financial statement for 2020 and that of 2021 becomes incomparable. It becomes very difficult to compare the two. So that's why we must always stick to one accounting basis adopted. Now, methods of accounting. We have various methods of accounting. We have the single entry accounting methods and the double entry bookkeeping. Single entry and double entry bookkeeping. So under the single entry bookkeeping, this is a straightforward method where one entry is made for each transaction in the books. Only one entry is made for a single transaction in the books. Recall I told us that before the end of this training session, show us how to maintain our financial records show us how to maintain our financial records even as non-accountant. So as non-accountant, you can maintain your financial records, you can maintain your bookshop accounts using the single entry bookkeeping. Under the single entry bookkeeping, what people do is that even if it means having a hard cover notebook where they document all their financial transactions, they do so. So when you have a hardcover notebook, record all transactions that happens in the business. So you record all your sales, you have a particular section that you record your sales, you have a particular section, you record a particular expenditure line, maybe salaries, you have another section, you record your repair expenses and all that. So basically that is a bookkeeping method in its single entry form, in its simple or simplified way. Some people still under this single entry bookkeeping, you see some people, they will buy what we call cash book analysis, cash book analysis book, cash book. They have cash column analysis book. It's sold in a bookstore. It's a cash book that has various columns. And each of those columns, you can decide to record all your financial activities. You may have the first column to record all your sales activities. You say, okay, when I make purchases, I record it in the other column. When I incur salaries, I record it in the other column. When I pay for transport expenses, I record it in the other column. When I pay for commission, I record it in the other column, so on and so forth. So that at the end of the financial period, maybe 1 year time, you sure have a total summary of all amount that has been incurred for each of these expenditure line and all amount that has been generated as far as your revenue, your income, your sales is concerned. So that is a simplified way of maintaining your financial records, a single entry bookkeeping method. I also see some people, they say, oh, maybe we don't have time to maintain these records. For every check that they issue to their vendors, they write it on their check stub. Check stub is just a small leaf attached to the check booklet. When you tear the check leaf out, the other booklet that is still attached, the other leaf that is still attached to the booklet, you see some people, they will fill in the details, populate the details of that transaction so that at a future date, when somebody wants to prepare their financial records, the person will know what that check, what that payment actually relates to. So that's another way of maintaining your financial records in a simple way. So that's for the single entry bookkeeping. The other one is the double entry bookkeeping. That double entry bookkeeping, this is more robust. It follows the principle that every transaction affects at least 2 accounts, and they are recorded as debits and credits. So under the double entry bookkeeping, we have what we call the double entry bookkeeping, the debits and the credits, meaning for every transaction that happens, there has to be a debit and there has to be a credit for the same amount. So this may not necessarily appeal to non-accountants, meaning the people that we expect to use this double entry bookkeeping are the accountants, account clerks, or the bookkeepers who have knowledge of accounting, who have knowledge of bookkeeping, and are conversant with the whole debit and credit entry rules. So for those who don't have accounting knowledge, you are advised to stick to the single entry bookkeeping. Those who can afford the services of account clerks, bookkeepers, or financial accountants, they can use the double entry bookkeeping. So here's an example before us. If you sell a bag of cowpea for 20,000 naira, what should be the entries? Sales is being made for cowpea. So obviously you debit cash and you credit sales account. So you see, just for a single transaction, a sales transaction, 2 accounts have been affected here. The debit account, which is the bank, if the money was paid into your bank, or your cash, if the customer paid you cash, then the credit becomes the sales account. So don't forget, like we said, if this will be cumbersome for you to use, it's advisable that you stick to single entry bookkeeping, because the end product is that after the bookkeeping exercise, you're able to hand over your records, your bookkeeping records, to a qualified accountant who then draws up your financial reports from it. Now, there's what we call accounting systems. Accounting systems are designed to collect, document, and report on financial transactions affecting business. Accounting systems are designed to document and report on financial transactions affecting systems. So when a company sets up any system that helps it to collect, to document, and to report on all their financial transactions affecting the business, we say that such system has designed its accounting systems. So accounting systems can be in two ways. It can either be manual accounting system or computerized accounting system. For the manual accounting systems, accounting transactions are processed by hands. So under the manual accounting system, accounting transactions are processed by hands, meaning you record the accounting transactions with the use of hands. So those who use hands to record the accounting transactions, maybe filling it on the analysis column cash book, filling the transactions on the check stubs, filling the transactions on their hard note cover book. This bookkeeping, these accounting methods is being manual. The accounting system is being manual because it is basically being processed by hands. Then the other type of accounting system is the computerized accounting system. Under the computerized accounting system, financial information is recorded by entering it into a computer. So when a company uses computer to record its financial transaction, its accounting transactions, it means that the company, the entity maintains a computerized accounting system. So computerized accounting system tends to be more reliable and more accurate than the manual accounting system. Of course, you know, anything that has to do with computer tends to be more reliable. A good example of the computerized accounting system could be spreadsheets, what we call the Excel. So the Excel is a good example of the computerized accounting system. There are also some accounting softwares that businesses can deploy to help them maintain their financial records, to help them keep their books of accounts. A good example is the Sage Peachtree, QuickBooks, Tally, and the likes, GXT Finance and the likes. So these are accounting softwares that companies can deploy in order to manage their financial records. Now, even though we have said that the computerized accounting systems tend to be more reliable and more accurate than the manual accounting systems, that does not preclude them from error. They also contain error in their own way. And this type of error that the computerized accounting systems tend to have is man-made. In most cases, they are man-made. That's what we call GIGO, garbage in, garbage out. If the account clerk or whoever that is responsible for feeding this information into the system makes a mistake by feeding a wrong figure into the system, there is no way the end result or the end product of the computerized accounting system will be correct. So that's why we said it is GIGO, garbage in, garbage out. It will still contain error, but whichever way we look at it, the computerized accounting system tends to be more accurate than the manual accounting system. So you have to understand the basic bookkeeping behind what you entered into the computer program in order to enter it correctly. So even as you deploy accounting software to help you manage your financial record, it's also expected that at least you must have somebody with knowledge of accounting and bookkeeping to help you in making those postings into the system for this to work efficiently and for you to have a reliable data, for a reliable report. Still on accounting systems, there's what we call GAAP, Generally Accepted Accounting Principles. Generally Accepted Accounting Principles. All accountants use the same set of rules to prepare financial reports. Every accountant has rules, regulations, norms, principles, binding and governing the way and manner financial reports are to be prepared. And the Financial Reporting Council of Nigeria, FRCN, is responsible for the issuance of these rules. It is the FRC that issues these rules that accountants and preparers of financial reports must abide with. Let me give you an instance. You see, the reason why FRC and Financial Reporting Council of Nigeria comes into play here is to regulate the practices of accounting, to ensure that whatever financial report that is produced is as realistic as possible. Make sure that they are faithfully represented, they are unbiased, as the case may be. Financial statements have various users, ranging from internal users and external users. So you see that every user of financial information has its own intending need, intending purpose for relying or for wanting to use the financial statement or have access to the financial statement. Let me give you an instance. Business owners, some business owners may not want to pay taxes. They don't want to pay taxes. And business owners, investors, shareholders, some of them may want to prepare the financial statement in a way that profit will be so low, and when profit is so low, it leaves them with little or no taxes payable to the government. Then you see another user again, maybe a manager who is entrusted with the day-to-day administration of the business by the investor. The shareholders appoint the manager who runs the business on their behalf, and the manager is being promised some incentive, a reward system that is based on profitability, like we have in the banking sector, where if profit grows to a particular percentage, the managers are entitled to a particular profit sharing. So you see the managers do everything to want to influence the financial statement, to manipulate the financial statement in order that they earn the reward, the incentive that is attached to the financial statement. So various users with their varying needs, for all of them not to manipulate the financial statements, for all of them not to create the financial statement in a manner that is more suitable to them. That's why the Financial Reporting Council of Nigeria comes into play to ensure that whatever financial statement that is presented is faithfully represented and it is unbiased. Financial statement must not be prepared in order to favor the needs of a particular user, be it the owners of the business, be it the investors, be it creditors and all that. It must be faithfully represented. It's expected that a financial statement should report events as they are. Now we have financial reports. Financial reports are summarized information about the financial status of a business. Let me say here that the end product of the bookkeeping activities that we have been discussing is for a company to be able to generate its financial reports thereof. Having maintained your bookkeeping activities, it's expected that when it comes to amend, you can either draw the financial report yourself or you hand over the bookkeeping reports. You hand over the bookkeeping or the bookkeeping you have maintained, you hand them over to a qualified accountant who then draws up a financial report thereof. So as I would say, financial reports are summarized information about the financial status of a business. And every business is seen, accounting is seen to be a language of business because it is so fundamental to the communication of financial information. Accounting is often called the language of business because in accounting, we basically concentrate on the documenting of all naira and kobo that comes in and out of the business. That's why it's called the language of business. Accounting reports are further divided into two main broad categories. We have the financial accounting and the management account. Financial account focuses on reporting information to external users. So any financial reports, any accounting reports that is produced to serve external users' needs is what we refer to as financial accounts. So when an account is prepared to serve the external users' needs, that account is referred to as financial accounts. I will tell us those who constitute external users and internal users in our next slide. Then the accounting reports that focuses on reporting information to management, often referred to as accounting for internal users of accounting information. That accounting report is referred to as management account. So basically, management account is produced for internal consumption, for internal users' needs. Those who are considered to be internal members, internal users of a company, the kind of report, accounting reports that is to be handed over to them should be management accounts. But as far as management accounts is concerned, the difference between them, between financial accounts and management accounts, is that management account is the one prepared internally for management decision making, while financial account is prepared for external users' consumption. The basic difference between them is that financial accounting is usually being audited. It's being audited. External auditors are usually invited to express their opinion, to review what has been prepared by the company, and express their opinion on it before they are sent outside to external users. That's why they are called financial accounts. But the one that doesn't have audit opinion, one that is unaudited, is what we refer to as management account. And because it is for internal users' needs, such as the management team, you don't need to express opinion. Auditor doesn't need to express opinion on them. So here are examples of external users. External users are individuals outside the business who have interest in the business. So anybody outside the business that has interest in the business, the person is considered to be an external user of accounting reports. Example of external user of accounting reports range from government. Government is example of external user. Example of this government may be FRS, FCT Land Revenue Service. Because FRS will always demand for companies financial reports, accounting reports, in order to assess them on tax. That makes them external users. If you're also in a line of business that involves government regulation, maybe you are into insurance business, of course, your financial report, your accounting report will be submitted to NICOM, National Insurance Commission. If you are into pension activities, maybe you run a PFA, pension fund administrator, like the ARM, Stanbic IBTC, their financial statement will have to be submitted to PENCOM, National Pension Commission. So these are government agencies responsible for regulating the activities of a particular business, and as such, they will be interested in the accounting reports of the business. Then general public. The general public also will be interested in the accounting reports of some businesses. The kind of businesses here are quoted companies, the PLCs, those companies that have their shares trading on the floor of the Nigerian Stock Exchange. Examples are Zenith Bank PLC, Julius Berger PLC, Konoy PLC, Dangote PLC, and the likes. So these PLCs will always make their financial statement public. Many times you see them on the websites, being uploaded on their websites. Even when you go to Securities and Exchange Commission websites, you see these financial statements or accounting reports being uploaded there, because they are PLCs, public liability companies. And so their financial statement must be made open to the general public who may be intending to invest or buy shares in this company. Then the civil societies also are members of the external users. They form part of the external users, civil societies. So businesses and companies may have their activities being monitored, being reviewed by civil societies, who may occasionally call for the accounting reports of the business. Then lenders. Lenders are those people who provide one form of funding or the other to a business. So a lender in this case will be maybe National Microfinance Bank. If you successfully get the fund being disbursed to you by National Microfinance Bank, of course, you will be answerable to National Microfinance Bank being your lender. National Microfinance Bank will always want to see your accounting reports if the need arises. So that makes it and external users. So these are some of the external users of accounting reports. Now, for the internal users of accounting report, they are individuals inside the business, those members of the business who also rely on the accounting report. Example is the shareholder, the owners of the business. They will always want to see the accounting reports. The managers, those who are entrusted with the day-to-day administration of the business, they want to see what the accounting report looks like after it has been prepared to help them with their decision making. And the employees, those who have been employed by the company, they also want to see the financial report in order to help them assess how far they have performed so far. So these are the internal users of accounting reports. Now move on to primary accounting reports. There are basically 3 primary accounting reports to be produced from our bookkeeping activity. Every bookkeeping activity, if well maintained, will help companies prepare or generate any of these 3 accounting reports or all of these 3 accounting reports. Number 1 is the balance sheet. Balance sheet. What then is balance sheet? Balance sheet is a statement that shows what a company has and what a company owes the outsiders. Any statement that itemizes what a company has, what belongs to the company, on one hand, and on the other hand, what a company owes outsiders. That is referred to as a balance sheet. So when you see a typical balance sheet, any moment from now, in a few slides from now, I will show us a typical format of a balance sheet. You will see how balance sheets are, the way they are presented. You will see that one column represents all what we call assets of the company, what the company has. And one column, the other column represents what the company owes in terms of borrowings to outsiders. So balance sheet basically is prepared to show the financial position of a company. Financial position as they are being represented by assets, liabilities, and equity. So there's what we call balance sheet equation. Balance sheet equation is that at every given point in time, liabilities plus equity must equal your total assets. Liabilities plus total equities must equal your total assets. Liabilities and equities must equal your assets. Let me give you an instance. If you have a total assets, for your company of say 10 million naira, the company has total assets, meaning all what your company can make boost of is 10 million. That asset would have been funded either by equity or by liability. It therefore means that the total assets of 10 million would have either been contributed via equity, capital contribution by the owners of the company. It could be that the owners of the company may have contributed 6 million, for instance. And if owners of the business contributed 6 million, for instance, it therefore means that the balance of 4 million is definitely coming as a liability. So when you add liability and equity together, it must give you the total value of your assets. Then the next primary accounting report is income statement, what we refer to as statement of profit or loss. Statement of profit or loss is a statement that is prepared to show how much in terms of profitability that a company records in any financial year. Statement of profit or loss, or income statement as it's fondly called, is a statement that is prepared to show how much in terms of profitability that a company makes. So for income statements, basically a company aggregates all its sales and deducts all its expenditures. So this is expected to leave the company with either profit or loss. So when the sales exceed the total expenses, we say that the company has recorded profit. But if on the other hand, expenses outweigh the sales, therefore means that the company has recorded losses for the period. So emphasis here for preparing income statement is for profitability sake, to see how much profit a company has raked in any financial year. Then another primary accounting report is the cash flow statement. Cash flow statement is a statement that is prepared to show the liquidity position of a company. The main reason why companies prepare cash flow statement is basically to reveal how liquid the company is. What do we refer to as liquidity? Liquidity means ability of a company to settle its short-term debts when they fall due. When your short-term debt falls due, ability to settle them immediately suggests that your company is highly liquid. I mean, if you owe some people like NASA Microfinance Bank who have provided you with the funding and you're expected to repay back at the appropriate time, both the principal amount and the interest. When you pay back those amounts, the amount is due. Are you able to meet up with the repayment terms when they fall due? That's what we mean by liquidity. You buy goods on credit, you owe suppliers and vendors. When the time is due for you to make payments, are you able to quickly make those payments? Ability to make those payments when they fall due suggests that the company is highly liquid. When ability to settle those debts when they fall due, it means that the company is not liquid. So when we prepare cash flow statement, it's basically to reveal how liquid the company is. And liquidity is represented by the cash and cash equivalent that a company has. Cash at bank, cash at hand, short-term investments that a company has. So all of these put together will suggest how liquid a company is. If a company has enough resources at its disposal, either at hand or in the bank, to quickly lay hold of and settle liabilities when they fall due. Then this is a balance sheet, just like this tries to explain the balance sheet equation we discussed earlier, where we said liability plus equity must equal the value of assets. Then for income statement, recall we have income statement as a revenue. For the revenue minus expenses, it leaves us with either profit or loss. Remember we said if the expenses are more than the revenue, then the company will be in a loss position for that particular period. And these accounting reports are usually produced annually, meaning every 12 months. It's expected that this income statement, this statement of financial position, or what is known as balance sheet, these cash flow statements are prepared on annual basis. So here is an example of a balance sheet. This is what a typical balance sheet format looks like. You notice that on the left-hand column, we have the assets, while on the right-hand column, we have the liabilities and equities. Now, let's start off by looking at the assets on the left-hand column. Assets of companies are further subdivided into two. We have the current assets and the non-current assets. Assets are further subdivided into two, the current assets and the non-current assets. What then is current asset, or what constitutes current assets? Current assets are items. Don't forget that assets generally are resources belonging to the company, meaning anything you see under the column for asset is resources belonging to a company. So current assets now are resources belonging to a company which is expected to be converted to cash within the next 12 months. So any item that we see under current assets, any item belonging to a company which can be converted quickly to cash within the next 12 months is categorized as current assets. A good example is a cash and cash equivalent. So when you have cash and cash equivalents, either sitting in the bank, already in its liquid form, there's no form of conversion anymore. Account receivables, customers who have bought on credit from your company, your debtors, those who are owing you, they are bought on credit. We call them account receivables. So because they owe you and we expect them to pay within the next 12 months, that's why they are categorized as current assets. The asset to you because you're expecting to receive that fund from them. Inventory. Inventory are items held for resale. When you have an item that you are holding for resale, that item is referred to as inventory. And because these inventories are expected to be sold within the next 12 months, they are classified as current assets. Prepaid expenses, payment in advance. Sometimes we call it payment in advance. When a company pays for expenses in advance, a company pays for expenses, but the company has not enjoyed the goods or services. It's an asset to the company. Example of prepaid expenses, you may have rent. You see some companies, they pay 2 years rent, 3 years rent. At the end of the year, you are preparing your account, this balance sheet. Any rent that relates to a future date which the company has not enjoyed, that will come as prepaid expenses, meaning that the company has paid in advance and is an asset to them. Then investments. Any investment of a company that has maturity within the next 12 months is categorized as current assets. You see some companies, they may invest in what we call fixed deposits, short-term treasury bills, and the likes, because they are due for conversion into cash within the next 12 months. They come under the current assets. Then the non-current assets, under the non-current assets, we have property, plant, and equipment. Property, plant, and equipment are those items tangible in nature which can be touched, felt, which can be seen, touched, or felt, which is used for the production of goods and services. Example is the land and building. When a company has land and building, it uses it to do what? To generate revenue. Equipment, office equipment, plant and machinery, motor vehicles, these are examples of non-current assets. Non-current assets are expected to live beyond 12 months. Non-current assets are items belonging to a company which is expected to live for more than 12 months. In other words, they are not easily converted to cash. They cannot be converted to cash within the next 12 months, like the current assets we said. So the non-current assets are hardly converted into cash within the next 12 months. Still under the non-current asset, we have the intangible assets. What is intangible assets? Intangible assets are identifiable non-monetary items without physical substance. In other words, they are assets, they are items that a company uses to generate revenue which cannot be seen, felt, or touched. Any item you have, you use in generating revenue, you cannot see, touch, or feel it. Call it intangible assets. Example of intangible assets, you may have a license, a fishing license, a mining license, you understand? For the fact that you have paid for that license, it gives you exclusive rights to do what? To generate revenue. You have a fishing license that allows you to fish from a particular river and earn revenue. That license is categorized as intangible assets. You cannot see, feel, or touch it, but it helps you with revenue generation. That's why it's called intangible assets. So that is all for the assets. Let's move over to the liabilities and equity, which is on the right section. Liabilities are also subdivided into current liabilities and non-current liabilities. Just like we divided the assets into current assets and non-current assets, the same way liabilities are subdivided into current liabilities and non-current liabilities. What then is liability? Liabilities are amount owed to third parties by the business. So any balance you see under liability means that this business, Teddy Fabbing Corporation, is owing outsiders, those people who have provided one form of funding or the other, or those people who the company Teddy Fabbing Corporation is now owing. Example of current liabilities. Current liabilities are those indebtedness of a company which is expected to be settled within the next 12 months. So when a company owes a liability and that liability is meant to be settled within the next 12 months, it is definitely classified under current liability. Example is accounts payable. When a company has accounts payable, it means the company has probably bought goods on credit from its customers. When you buy goods on credit from your customers, that amount, we treat it as accounts payable. And that balance is expected to be settled within the next 12 months. That's why it's coming under current liability. Notes payable, any portion of loan which is payable within the next 12 months will come under the current liability. Accrued expenses, expenses for which the company has enjoyed the goods or services but they have not settled for it. This is an example of accrued expense. Salaries and wages being owed is an example of accrued expenses. Tax being owed to the tax authority is an example of accrued expenses. So they will come under liability because they're expected to be settled in the next 12 months. Deferred revenue, if a company receives revenue but have not supplied the goods or services for which the revenue was received, it becomes a liability to them, meaning that they are indebted. They are indebted and it is treated as current liability, the deferred revenue. After the current liability, you have non-current liability. Non-current liabilities are indebtedness of a company which cannot be settled within 12 months. In other words, the indebtedness of the company, the amount the company owes, usually will span over one accounting year, over a 12-month period. So, a good example of non-current liability will be your NISA microfinance loan. If you successfully secure this NISA microfinance loan, such loan will be accounted for as non-current liability in your financial statement because that loan is not repayable within the next 1 month. It takes a number of years before that amount is repaid to NISA. And as such, it should be treated as non-current liability. Then we'll move on to shareholders' equity, what we call equity. Ordinary share capital. Ordinary share capital of the shareholders comes under the equity. Retained earnings, all accumulated profits or losses belonging. So anything about shareholders' fund or equity is what belongs to the shareholders, owners of the company. They are being represented here. Their share capital, their retained earnings, their valuation reserves, and all that. All of them are being recorded under the equity section of the balance sheet. So I want you to observe that the total assets given as 472,100 is the same with the total equity and liability. Total assets must equal the total liability. If it doesn't equal, it means something is wrong. So total assets and total liabilities must always be the same. They must equal for us to say that our accounts are balanced. Then we'll have the profit or loss account, the income statement, as we fondly call it, income statement. So for the income statement, you basically notice that you have your sales. For your sales, you aggregate all the activities that earned you revenue or sales in a particular year you are reporting. Take, for instance, look at what we have on the screen. You have sales. For the sales activities, you have client service revenue, book sales, professional consultation, and total sales. So it's expected that we itemize all the activities that earned the company the sales. May be involved in farming and you farm various products. It's expected that the revenue from each of these product lines must be stated. You should be able to do what? To categorize them on the face of your income statement, on the face of your profit or loss accounts. Maybe you farmed yam, you farmed maize, you farmed beans. It's expected that you express them. You show the revenue earned by each of these line items. The revenue earned from maize, the revenue earned from yam, the revenue earned from beans. Should be able to split them on the income statement so that anybody who is looking at this financial statement, this income statement, will know which one generated more revenue in the year you are reporting. So when we have the total sales, we now aggregate all the total expenditures. Expenditure can vary depending on the nature of your activity. Some people may have wages and salaries, others may have marketing and advertisement, others may have rent, others may have utilities, others may have memberships and publication, others may have repairs and maintenance, others may have transportation expense, others may have legal and professional fees being part of their expenses. Some may have repairs and maintenance, so on and so forth. So it's expected that all of these expenses will have to be aggregated. We aggregated the total should be taken off from our sales to leave us with profits before tax, after which we now pay income tax or make provisions for income tax, because taxes are usually paid in arrears, meaning you don't pay taxes in the year you are preparing the account or in the year the account relates to. You wait for the year to come to an end, then you are allowed some months, 6 months max, before you can now file your return. So provisions for taxes are to be made. So you see that this income statement has 2 columns. We have 2 columns, the current year, which is 2004, and the prior year, last year, which is 2003. It is very important that when we prepare our income statements, we also need to include that of the prior year, the one for last year. It should be included. Reason we're including that of the prior year alongside with the current year we're reporting is that it helps users of financial information take adequate or make adequate informed decisions. Anybody who looks at this income statement will be able to assess if the company recorded a growth or decline from 2003 to 2004. So when you present comparative figure, we call it comparative figure, figures for prior year, the last year, 2003, users of financial information can judge and appraise the performance of the company. The financial statement becomes comparable. So this is what a format of income statement looks like. Now, components of accounts. Components of accounts. The basic unit of accounting is an account for general ledger. General ledger account. It is a unit of information that represents business records. There are 5 types of account components. No matter the account you prepare, that account will constitute any of these 5 components. It can be made up of either assets, it can be made up of either liability, it can be made up of either equity, it can be made up of either revenue, it can also be made up of either expenses. So assets, liability, and equity, the first 3 among these 5 components, they are basically used for preparation of balance sheets. First 3 of the components of accounts are used for the preparation of balance sheets. That's the asset, liability, and equity. While the last 2, revenue and expenditure, they are used for the preparation of income. That's a profit or loss account statement. So a business can have anywhere from a dozen to several thousand accounts, with each one being one of the 5 types, meaning no matter the accounting transaction as they are being presented in the financial statement, it must belong to any of these 5 components. If it's repair cost, it belongs to any of these 5 components. Repairs is under expenses. If it is sales of your crops, it belongs to any of these 5 components, which is definitely a revenue. If it is cost of sales, it belongs to any of these, which is definitely expense. If it is ordinary share capital, it belongs to any of these account components, which is equity. If it is profit as reported for the year, it belongs to any of these, which is equity also. If it is your motor vehicle or your land and building or your office equipment, they belong to any of these, which is definitely what? An asset. So no matter the account transaction, the account line in your financial statement, they definitely belong to any of these 5 components. So accounting is a process of recording, like we said. Accounting is a process of recording, like we said. Accounting is a process of recording business activities that make changes to accounts. I see that somebody's hand is up. Chinemerem Iguanusi, your hand is up. Maybe you want to talk to us. Okay, can you? Okay, Chinemerem, can you go ahead and talk to us? I think you have been unmuted. Can you talk to us now? You're muted. Okay, Chinemerem, talk to us. Hello? Chinemerem. Okay, we just have to continue. We just have to continue. So we'll meet everybody back. If you have any observations, we expect you to raise your hand just like Chinemerem raised his hands. So accounting is the process of recording business activities that make changes to accounts. These include sales of products, meaning when a product is sold by a company, it's expected that it should be recorded. When the revenue from services are earned, it's expected that okay. So we said accounting is the process of recording business activities that make changes to accounts. These include sales of products. When a company sells its product, it's expected that the accounting entries are to be made. When a company receives revenue from services, and it's expected also that the accounting entries and documentations must be made. When a company buys goods or services, it's expected that the accounting entries also should be made. Incurring other expenses is also expected that accounting entries should be made. Depreciation of fixed assets will also require a company making accounting entries. And we talk of closing the accounts, but like I said, most of us do not have accounting knowledge, and as such, we may not be able to close the accounting books. So this class is still restricted to bookkeeping and financial planning. So when any of these and other business activities are recorded, accounts balances will change in value. When a company makes sales and record the sales account balance will change. In some instances, the bank balance will change, the cash balance will change, the receivable balance will change. When a company buys goods or services, it's expected that the purchases will change. The cash balance will change as well. So any of the activity that happens in a company will cause any, if a transaction happens in a company, to cause any of the accounting balances to do what? To change. Cause any of the accounting balances to change. So here is double entry accounting. For any business transaction that happens, two or more accounts are affected. There is a give and take of equal naira. Any account transactions that happen, this will give rise to two accounting entries. We call it the debit entry and the credit entry. Debit entry and the debit entry. In fact, they are called double entry. Remember we said at the beginning of this class that because we understand that some of us may not have the accounting knowledge, we will not dwell so much on this double entry bookkeeping. And we said those who can afford the services of an accountant are advised to do so, because it is this accountant, these bookkeepers, these account clerks that will be able to document your bookkeeping records in a manner that is suitable and also maintain the double entry rules, which is the debit and credit. But in any case, we said if we cannot afford the services of an account clerk, bookkeeper, or an accountant, maybe because the business is in its early years of operation, you can also maintain the records yourself. You can use the single entry bookkeeping method, which we have discussed, which is like maintaining the books in your analysis column cash book, in your hardcover notebook, or filling out your check stubs each time payments have been made. So a debit to an asset. There are two types of actions done to accounts to bring the values up or down. The actions are called debit and credit. Whether an account grows or shrinks when it is debited or credited depends on the account. So some accounts are debited. If you debit some accounts, they grow in value, while some accounts, if you debit them, they reduce in value. Some accounts also, if you credit them, they increase in value, while if you credit some accounts balances, they reduce in value. So depending on which account it is. So a debit to an asset account makes it bigger, but a debit to a liability will only make the account smaller. The opposite applies when crediting. But like I said, I don't want to bore you with all of this debit and credit. Let me show you something quickly. You see these 5 components of accounts, which we said assets, liability, and equity, revenue, and expenses. They have by default what we call their balances by default. The first and the last, which is asset and expense. Asset and expense have a default debit balance. Assets and expenses have a default debit balance, meaning the balances have default debit. Having a default debit balance means each time an asset is bought or each time an expenditure is incurred, it's expected that since they have a default debit balance, the debit entry should be made to this asset class. If a company buys a motor vehicle, it means that assets will have to be debited because they have a debit balance in order for the assets to grow bigger. Or if a company sells part of its assets, the asset will be credited and the value reduces. The same thing applies to expenditure. If a company incurs expenditure, the expense line will be debited. If a company sells its expenditure or makes adjustment to its expenses, the expense value will be credited and it reduces in value. So asset and expense, the first and the last, the first and the fifth among these components have debit balance, while the 3 in the middle, which is liability, equity, and revenue, have credit balances. Liability, equity, and revenue, they have credit balances. By default, they have credit balances, meaning when entries are posted into them, any credit entry made into these accounts that ordinarily have credit default balances, the balances will grow higher. Or when a debit entry is made, these account components that we say have a credit balance, when a debit entry is made to them, the balance will reduce them. That entry will reduce them in value. Okay, so debit and credit make accounts either go up or come down depending on what it is. So a debit to assets and expenses will make the asset or expense grow bigger, where credit to asset or expense will make the assets or the expense lesser. Then when we get to liability, equity, and revenue, a credit to revenue, equity, or liability will make any of those 3 account balances go bigger. A debit to them will make them go smaller or shrink, as the case may be. So on this note, ladies and gentlemen, I want to thank you for your audience. The floor is now open for questions and answers. So can we take questions? If you have questions, it's expected that you indicate by a show of hands. You can physically show your hands. You can click on the raise hand icon so that we know that your hands are up. you can also leave us with a chat. Okay. Thank you very much. We see your comments on the chat box. We appreciate you for that. Wonderful comment. So the floor is open for questions. Except there are no questions or observations, we may just have to go straight to the post-lecture quiz. We just have to administer the post-lecture quiz.
I want to type question. Okay. Well, I should type it now.
Okay.
I can type. Okay.
Any question? You have question? Observations, comments? Okay, if you don't have questions, observations, or comments, quickly administer the post-lecture quiz. And it's expected that you make attempts of this post-lecture quiz. You
want to go back to the teaching?
Okay.
Are you still hearing me?
Wait. I let him see whether how to ask the patient. I'll send it to a common chat box. Go. Can I go there?
You want to go to the last page?
I want to mute that and talk.
Okay. Okay, you want to mute this thing.
I'll mute so that I can explain. I can.
Okay, we can hear you, Mr. Sunday Ali. Unmute. Mr. Sunday Ali, we can hear you. We see your question on the comment box. You said you need more explanations on common stock on the balance sheet. Common stock represents the ordinary share capital. You know, as companies are being incorporated through CAC, Corporate Affairs Commission, the unit of shareholding is represented by the ordinary share capital. So the ordinary share capital, sometimes we refer to them as common stocks. That's what we have on the balance sheet. It is part of the equity item as being presented in the balance sheet. I hope this answers your question. Any more questions? Okay, if there are no more questions, the post-lecture quiz has just been shared on the group, the WhatsApp group. So it's expected that you make attempts and you have just 5 minutes to do so. You have just 5 minutes to do so. And I've taken account of everybody here. It's expected that you don't sign out. Just take 5 minutes, complete the quiz, and return your answers to us. So quickly do that. Basically watching at all of you. I'm looking at all of you. Nobody should leave. Exactly by 12 p.m., the class will come to an end. The link to the quiz has also been shared on this platform, the Zoom platform. It's both on the Zoom platform and on the WhatsApp platform. So I see people scoring hundreds in my post-lecture quiz. That's good. That's encouraging. It shows that you have listened attentively. Okay. So it's about 12 noon, and the time for the post-lecture quiz is up. Some of you have returned your answers, and the performance is encouraging. So we are proud. At least you paid attention, you listened attentively. So on this note, we would like to end the classes for today. We'll converge tomorrow, 10 a.m. that same time for tomorrow's presentation. So on this note, we want to appreciate every one of you for your time and your attention. So do have a lovely day, and bye for now.